Welcome to the SouthBuy channel. Here we try and find stocks that don't get much airtime, and we teach how these companies can be valued using standard valuation methods like discounted cash flows. We use unique screeners to find some gems and share our analysis with you. Like many stocks, Goodyear Tire and Rubber has had a rough start this year. Goodyear has had many challenges in the last 3 years. Supply chain issues cause a rise in costs, as well as global lockdowns causing a reduction in demand. Stabilizing their business in this post-COVID world has been their focus. An increase in demand is expected, but they are increasing their working capital to meet this demand. GT share price has dropped 45% since the start of 2022. I explore the bull case for GT, as this seems to be a unique buying opportunity. The Goodyear Tire and Rubber Company is one of the world's leading manufacturers of tires, with one of the most recognizable brand names in the world, with operations in most regions of the world. They have a broad global footprint with 57 manufacturing facilities in 23 countries, including the United States. They operate their business through 3 operating segments representing their regional tire businesses: Americas, Europe, Middle East and Africa, and Asia Pacific. GT has shown good performance in 2022 versus 2021. The acquisition of Cooper Tires has added $599 million to net sales of the Americas. Volumes and net sales have increased across all regions. These increases have been due to increases in demand post-COVID and increases in price due to inflation. This improvement in demand is what makes me particularly optimistic about the industry. 2022 has been filled with one historic event after another affecting every stock. GT share price at $13 is still higher than its prior year levels. They have done an excellent job turning their business around after 2 tough years in. They have made many efforts to work on cost efficiencies as well as improve their revenue mix. Profit margins have turned positive to 4% since global lockdowns ended. GT is a high-volume, low-margin business, and I expect demand will be picking up into 2023. The current PE ratio of GT is 4 compared to a peer average of 11. I believe this means that a bullish case can be made. The annual earnings growth expected is only 2.7%. They do face many headwinds. Managing those headwinds and turning profitable has been key. Their performance in the last year has been phenomenal compared to the industry. GT share price has been range-bound between $14 and $10 throughout 2022. The market is waiting to see if it can hit its targets. It's my view that the GT targets are achievable and that they exceed these market expectations in the near term. Purely comparing the GT PE ratio to the average, we can see that all they need to do is deliver on the 2.7% increase in revenue. This will result in the price closing the gap between valuation and share price in the near to medium term. I believe comparing them to their peers, GT is underpriced. Looking at the above analysis, we need to corroborate this valuation further. We will do this by comparing it to the industry and performing a discounted free cash flow model. Compared to the entire U.S. auto sector, I believe they are undervalued. Companies like Lear and Aptiv are companies with 60+ PE ratios. This shows that the market believes high growth can be obtained from this industry. These high PE companies are mostly in the business of engineering solutions. The larger market cap companies in the industry are around the 14 PE ratio mark. This puts GT PE ratio in more perspective. In my opinion, this would indicate that they are undervalued, because they are in a market dependent on global demand for vehicles and mobility. A high-volume business that has been significantly affected due to lockdowns. Companies like Visteon are into robotics, which can bring much higher revenue growth due to labor shortages currently experienced. GT is a much more consistent business and is waiting for their time to shine. They are undervalued compared to peers and undervalued based on industry comparison. Based on the PE ratio versus industry and competitors, I have assessed that they are undervalued. Let's jump into the free cash flow discounted model. My favorite valuation is hands down discounted free cash flow model. The PE ratio analysis is good when assessing whether a stock is over or underpriced compared to other listed companies. This valuation method looks at growth factors and discounts with a suitable discount rate. The calculations below outline how an intrinsic value for Goodyear Tire and Rubber is derived. by discounting future cash flows to their present value using the two-stage method. we use analysts' estimates of cash flows going forward 10 years for the first stage. The second stage assumes the company grows at a stable rate into perpetuity. With this analysis, it is clear if they can maintain current revenue and grow slowly but consistently, there is significant upside potential over the next 3 to 5 years for this stock. A target price of $20 is high but achievable for a company like GT. GT faces some headwinds like so many companies listed on the stock market. GT has a combination of experienced and less experience on their management team. 7 of the 13 leadership team having been at Goodyear less than 5 years. Chairman Richard Kramer serving the longest for more than 12 years. From making losses in 2019 to turn the business profitable in 3 years is no small feat. This combination of youth and experience might be exactly what Goodyear needs to turn things around. Supply chain issues, shortage of raw materials, and the strengthening of the dollar. Some of the key headwinds increasing pressure on their operating margins. To counter this, they have built up stockpiles in 2022 to meet the expected demand in a post-COVID world. Another shortage is labor. A tight labor market has put added pressure on margins. GT has signed a 4-year master labor contract with the United Steelworkers that cover wage increases. This has created stability in the sourcing of labor and increases in wages. The automotive industry is going through immense change. With the rise of Tesla with the electric vehicle, the soaring prices of gas caused many people to think twice about that trip to the beach. It can be quite daunting. There is much to be optimistic about as many vehicle manufacturers are investing in producing electric vehicles. GT has been making key decisions as well as launching an all-new Goodyear electric drive all-season tire. Goodyear has delivered consistent revenue for many years now. They have put together a well-balanced management team in terms of experience. They have navigated the business through an extremely challenging 3 years. They have been able to turn a loss-making business into a profitable one. This is in a truly short amount of time. Demand for tires is expected to increase. Goodyear is positioning itself well to make the most of this expected increase. I believe based on the PE ratio and discounted cash flow analysis that we can expect good returns from GT over the next 3 to 5 years.